Everybody, welcome to the micro lecture for Chapter 16, where we talk about what money is and different ways of looking at money and the role of banking in the business world. The learning objectives we have for this chapter is to define money and identify the different forms that it takes in the money supply. We're going to describe the different types of kinds of financial institutions that compose the U.S. financial system and explain the services that they offer. Explain how financial institutions create money and describe by which means they are regulated. Discuss the functions of the Federal Reserve System and describe the tools that it uses to control the money supply, and identify 3 important ways in which the money and banking system is changing, and discuss some of the institutions and activities in international banking and finance. So most of us, when we think about banking, we think about this. We think about a branch of a store, almost that represents what a bank is. That's retail banking. It's a small part of overall banking. We just want to make sure that we understand that it really isn't just where you do your own banking at. There are lots of banks that you wouldn't know anything about that control lots and lots of assets. So, but that is part of it. But it's the face that we see. It's also changing, so people are doing a lot more online types of banking these days. That was unheard of not very long ago, and today it's common. So, kind of an interesting thing, how much that part has actually changed. So let's talk about money. What is money? And from a purely economic standpoint, this is the way we think of it. Money is a medium of exchange. It's a store of value. In other words, the dollar is worth $1. We think of that in terms of what it means, and it's a measure of worth. So we can say, if something is stated in terms of it's worth stated in monetary terms, we can use that as kind of a direct way to compare with other things that are also stored thought of in monetary terms. That is what the definition of money is. Not so much, what's currency and all the rest of that stuff, because money comes in a lot of different forms. Economists use it to determine lots of different things. We talk about how much currency is available inside. I'm not currency, wrong thing. I should have said that exactly wrong. I said it should be what is convertible money supply, and that is all the forms of money that are out there that we can add up. And we need to understand what that total is, because there's the theory is controlling the money supply, or the amount of money that's out there, can have a direct impact on the overall economy. And that was led by monetarist economics, which was, I can't say that it was developed by, but it was certainly the poster child for it was Milton Friedman, who was a economist from the University of Chicago, Nobel Prize winning economist back in the late 50s, early 60s, and really pushed forward the idea that controlling the money supply can control the economy. So central banks, which most economic systems have, actively manage the money supply by using different types of tools. So monetary supply tools have eroded somewhat in the past in terms of their effectiveness, and we know that, but they're still heavily relied on, and by things that you hear about in the news all the time. The prime rate is the rate which the top lenders borrow money to, lend money to the top borrowers of money. The reason I showed you this chart is it was very unstable back in the year 2000, and if you go back even further than that, it was even more unstable. But we've hit a period of relative predictability, which is kind of what you're trying to go for with this type of thing. But again, it was all these things we're trying to control these things through the money supply. So there's something called the money multiplier, which is an important concept that comes into play because it goes right into it, that whole concept of how much total money is there in the system. And so it's this concept that's what monetarist economics and it tries to control. So if I take my, I've asked this question of people before, and it's amazing some of the answers you got. But when you bring your $100 that Grandma gave you for your birthday last week, and you deposit it in your bank account, you probably think it's like, oh, they must take my $100 and put it into a little hole in the ground that has my name on it, and so that it's always there for me. And in fact, that's not the case. When you deposit that money, the Federal, I'm saying the Federal Reserve, but the Federal Reserve requires that they $10 of that $100 is withheld in the bank. Now, again, you have an account that says you have this much money, but you don't literally physically have that money sitting somewhere in an account, okay? Because the bank then takes that 90 of that $100 and they lend it to somebody else. When they lend that money out, the total money supply now is equal to that original deposit. Deposit plus the $90 that was lent out, so that raised the money supply to $190. And if they keep doing that exact same thing, you can see how the total supply of money is going up with each transaction. So that person that got the $90 deposits that the bank has to hold $9 in their institution. They take the other 81 and they lend it to somebody else. That adds that much more money to the money supply. So now we're up to $271, and you can go through the math through each iteration. And obviously, this keeps going on and on multiple times a day. And when you think about all these transactions happening and all this going on, are all increasing the money supply. Okay, so that's how banks create money. Not money in terms of cash, but money in terms of how we measure money in terms of the money supply. Okay, a couple of things that we think about is some of the regulations that are put on banks, and one of them that was put out there because banks fail. They do. They run out of money and they simply don't have you saw how they lend it out. So banks can fail, make risky investments, and do some bad things. And as you can see there, your original $100 is not there anymore. So to put your mind at ease that your $100 is okay, the U.S. government created something called the Federal Deposit Insurance Corporation, otherwise known as the FDIC. And this is a federal agency that guarantees the safety of deposits up to $250,000 per investor in the financial institutions that it insures. And you have to be a member of the FDIC as a bank to actually offer this, so to speak, or say it's available to you as an investor, as a depositor in their particular bank. And it's been used, and it gets taxed. Taxed meaning not literally the tax word taxed, but it gets pushed to the brink sometimes. So back between 2009 and 2010, because our banking systems were imploding, 272 banks failed. Very large banks failed. Lehman Brothers, Bear Stearns, these were very, very large banks that failed. So in 2009, the ratio of the amount of money that was the FDIC kept in terms of as a percentage of the total deposits that were out there that were insured by it really took a big hit, okay, and it created a huge deficit on the amount that the FDIC was on the hook to pay out, and of course the federal government was going to have to somehow pay that money out. There was a Banking Act was passed as a result of the 2009 to 2010 bank collapse, and it was called Dodd-Frank Act and required the FDIC to maintain funds of 1.35%, not the smaller percent, which was 1.24%. Now, they've actually kind of backed off on that over time. So we put the laws in place and the regulations in place, and then we hear politicians yammer on about how bad regulations are, and we put ourselves in exactly the same spot we were at before. So as they were keeping like 1.2%, that was more than enough to cover most of the activity of bank failure in those periods of time. When that many banks failed, they just simply didn't have enough money, so actions were taken to alleviate that. The Federal Reserve System, or the Fed, we've heard that all the time, they're the central bank of the U.S., in which acts as the government's bank and serves member commercial banks and controls the nation's money supply. That's the big one. And And we hear about this all the time. Now, most recently, got most of the attention came around. Will the Fed lower interest rates? And they've been raising interest rates to cool spending. Okay, and because the spending was contributing to the inflationary pressure that we've put ourselves into in our economy. And so they tried to actually control spending a little bit by making it more expensive to do that. So they raised up the interest rates or the costs of obtaining funds to spend, basically. So that's designed from a monetarist point of view. That's designed to actually bring that under control. Okay, I'm not going to go into this in a lot of detail, but the Federal Reserve is a huge. I'm not going to go into the U.S. history here, but there's a lot of history. Resistance to a centralized federal bank. People promoting it. We've gone back and forth, and before Alexander was a rapping founding father in a musical of a couple of years ago, he was known as one of the people very much involved in should we have a centralized bank when our government was first formed back in the late 1700s. So again, they're the government's bank. They're the banker's bank. They do check clearing. They do a bunch of different activities, but they control the money supply. So generally speaking, the more money supply there is, in other words, the more money we're creating, the higher their level of spending, and inflation is kicking in. That's why these conversations are getting so much attention in the last couple years. The less money supply increases greater than the amount of the supply of the money, lowers prices, and kicks into some deflation. Okay, so they want to be able to control the money supply. They do that by setting the discount rate. And that's basically that's the basic interest rate that all the other ones are more or less tied to, and the amount of money that they reserve. Remember we said that we took our $100 and said the Fed says that you have to keep $10 of that out. That's the reserve requirement. The discount rate, the interest rate, which member banks can borrow money from the Fed. So there's a lot of different things that they do to try to control the money supply, and they've been relatively successful doing it. But they've had to raise the rates up quite a bit over the last, like I said, a couple of years because of the amount of inflation that we're experiencing in our country. All right, so I gave you let me just give you one more slide. I think I have enough time to do it. One of the things that's happened is we've created massive banks. So today we look at Wells Fargo, Bank of America, J.P. Morgan Chase, and Citigroup. These are four of the largest banks out there. This, going back to not very long ago, was made up of a bunch of other very, very large banks that, through merger and acquisition activity, created these four massive, large ones. And that's led to the whole concept of what's too big to fail. Can we let any one of those banks actually fail? And there's a really interesting argument. And normally in classes where we have a little more time, we spend quite a bit more time on this. But yeah, it's a really interesting topic. So if you want to learn more about that, look at some of the optional stuff in our module for this chapter. Okay, I know there's a lot to cover there. Banks and banking is not a simple topic. There's a lot of things going on, but it gives you a rough overview of it. And if you have any questions, certainly let me know.